Welcome to Audio Mentors, your space to learn, grow, and find inspiration on every page. Here, we offer content that will accompany you on your path to personal and professional success. Today, we begin a new journey with the book One Up on Wall Street by Peter Lynch, an essential work for any investor who wants to understand the stock market in a clear and accessible way. Throughout this book, Lynch shares his philosophy and strategies that have allowed him to achieve great returns, using easy-to-understand examples and practical advice that anyone can apply. So get comfortable, enjoy each chapter, and if you like what you hear, don't forget to subscribe for more valuable content. Let's begin. Chapter 1. Introduction. The Advantages of Dumb Money. In the first chapter of One Up on Wall Street, Peter Lynch introduces one of the core ideas that will guide the entire book: the power of dumb money. The concept of dumb money doesn't refer to poorly managed or irresponsibly invested money, but rather something very different. Lynch actually highlights the advantages of non-professional investors, those who are not stock market experts but, at the same time, have a natural advantage over large funds and Wall Street professionals. What is dumb money? Dumb money refers to the funds invested by people who are not obsessed with daily market fluctuations, complicated analysis, or predictions from experts. Instead, dumb investors trust their own judgment and experience, making decisions based on what they know from their everyday lives. For Lynch, this type of investor has a significant advantage. They know the products and services they use daily, something that many Wall Street professionals simply cannot do. The individual investor has an advantage. An investor who is not obsessed with the complex strategies of the market can actually have the advantage of being more rational and having more direct knowledge of the products they invest in. Lynch argues that individual investors have an advantage when it comes to identifying opportunities in companies that are growing but are overlooked by Wall Street experts. Investment funds and analysts often get caught up in the speed of the market, the news, short-term changes, and daily recommendations. Professional investors also tend to follow the same trends and patterns, limiting their ability to identify companies that have great long-term potential but have yet to be discovered by the general public. This is where dumb money can shine. Individual investors, by being less focused on short-term movements and not following market fads, can capitalize on opportunities before large funds do. Know what you consume. One of the main lessons from Lynch in this chapter is the idea of investing in what you already know. We all use products, services, and technologies daily, but have you ever stopped to think about the companies behind those products? You are likely to have more information than you realize about some companies that could be great investment opportunities. Lynch explains that often the biggest and most successful companies are not always on the front pages of financial newspapers. However, they may be so close to us that we overlook them. From the clothes you wear to the restaurants you frequent, the tools you use every day, and the technology you constantly rely on, these are all valuable clues for identifying growing companies that could be excellent investments. The advantages of everyday knowledge. Lynch gives the example of companies that grow by offering products or services that are already part of people's everyday lives. Individual investors have the advantage of being active consumers, so they can identify these products before market analysts do. If you get excited about a product or service, it's likely that many other people do too, which could signal an investment opportunity. A simple but effective approach. While Wall Street professionals often focus on complex strategies and detailed calculations, Lynch encourages us to adopt a simpler yet equally effective approach. According to him, you don't need to be a financial expert to succeed in the market. All you need is to observe the world around you, identify trends, and make informed investment decisions based on what you already know and use. This approach is not only accessible but also emotionally more satisfying. Instead of delving into complicated analysis or listening to experts, individual investors can feel more comfortable investing in what they already know works, giving them more confidence to make long-term decisions. Investing with common sense. Instead of chasing the latest market trends or following the most popular recommendations, Lynch promotes investing in companies with a solid business model and long-term prospects. Using examples of large companies like McDonald's or Home Depot, which have benefited from steady and stable growth, He shows how common sense and basic knowledge can lead to finding successful investments. Lynch also reminds us that many of the most successful investors throughout history have followed this principle. Invest in what you understand. If you are an expert in a particular sector, your knowledge can give you an edge when identifying a company that is not yet on the radar of large funds, but has great potential. Conclusion: the power of simplicity. The central message of this chapter is clear. You don't need to be a financial expert or have access to insider information to be a good investor. In fact, dumb investors who apply a simple and direct approach, based on their own market knowledge, can be just as successful, or even more so, than professionals. Success lies in seeing what others don't, trusting your own instincts, and making investment decisions based on what you know. At the end of the day, Lynch reminds us that often, the best investment opportunities are closer than we think, in our everyday experiences. And with patience, observation, and a constant learning attitude, anyone can get a step ahead on Wall Street. Chapter 2. Those Wonderful 10 Baggers. In this chapter, Peter Lynch introduces a key concept in his investment philosophy, the 10 baggers. These are stocks that increase their value tenfold, or more, from the price at which they were initially purchased. For an investor, finding a 10-bagger can be a game-changer in their financial journey, as it represents an extraordinary return. Lynch argues that one of the most rewarding goals is discovering these growth stocks, which, over time, have the potential to multiply dramatically. The magic of 10 baggers. Lynch explains that the true magic of 10 baggers lies in their potential to generate extraordinary profits without the need to take significant risks, as long as the right companies are chosen. Finding a stock that increases 10 times its value is a complex task, but it's not impossible if certain investment principles are applied. Often, these companies are not the most well-known or on Wall Street's radar. Instead, they tend to be small, undervalued, or ignored by the analysts at large funds. The process of finding a 10-bagger. For Lynch, it is not necessary to be an expert in technology or volatile sectors to identify these opportunities. What's important is having the ability to observe and be aware of companies with growth potential that haven't been recognized by the majority yet. Small companies expanding in a promising market or those with a competitive advantage in their sector are often the best candidates to become 10-baggers. Lynch uses examples from his own investment experience, mentioning how he identified some of his biggest gains by investing in companies that were undervalued by the market at the time. Essentially, what an investor looking for 10-baggers seeks are companies that are growing, but not yet on the radar of major analysts. The importance of patience. One of the keys to finding a 10-bagger, according to Lynch, is patience. These companies don't become giants overnight. Often, the path to significant profit is long and filled with ups and downs. Investors must be willing to hold their investments for an extended period without being swayed by market fluctuations. This requires a long-term focus and a calm mindset that doesn't get swept up in short-term noise. Lynch also emphasizes that patience doesn't mean waiting passively, it means being prepared to act when conditions are favorable. As the market changes, some companies may not meet expectations, and it's important to know when to cut losses. However, if you find a stock with a solid business model and prospects for sustained growth, you may have a 10-bagger in your hands, even if you don't know it yet. Examples of companies that have been 10-baggers. Lynch offers several examples of companies that were 10-baggers in his own portfolio. Some of these, like Ford and General Electric, became huge successes because they capitalized on an expanding market and were able to offer products that met growing demand. However, Lynch also points out that not all 10-baggers come from big names or well-known sectors. Often, the best investment opportunities are found in less flashy companies that are better positioned to capitalize on future trends. One classic example he uses is Pepsi, which was one of his big 10-baggers. Although Pepsi wasn't the dominant brand in its sector when Lynch identified it, he understood that its distribution capacity and innovative approach positioned it for significant long-term growth. The concept of looking for the obvious. Lynch emphasizes that finding a 10-bagger doesn't require being a genius at investing. In fact, many successful investors are successful because they've made simple yet effective decisions, based on common sense. When looking for a 10-bagger, Lynch recommends focusing on what you already know and use. Often, the best opportunities are right under our noses. If you are an active consumer and are aware of emerging trends in your daily life, you can spot opportunities that others are overlooking. For example, Lynch suggests that investors look for companies with products or services that are already in consumers' hands, but haven't yet made a significant impact on the market. If something works well on a small scale, it's likely that, over time, it will expand and generate significant returns. Not always necessary to be an expert. A crucial part of Peter Lynch's approach is that you don't always need to be an expert in the sector to make a good investment. Just because you're not an expert doesn't mean you can't spot a good opportunity. In fact, Lynch argues that sometimes investors who aren't caught up in market speculation or analyst opinions can make a better assessment of a company. Instead of relying solely on complex technical analysis, Lynch believes individual investors can use their everyday knowledge and apply common sense to make smart investments. This is dumb money. The money from investors not caught up in market emotions can often spot opportunities that large funds miss. Conclusion: the importance of consistency and informed analysis. Lynch concludes this chapter by emphasizing the importance of consistency in the search for 10 baggers. It's not just about identifying a stock that could multiply its value tenfold, but also about maintaining a grounded and consistent investment strategy. The investor should be willing to follow their intuition, be patient, and maintain a long-term vision, without rushing to sell a stock due to small losses or market fluctuations. 10 baggers are not easy to find, but by applying a well-founded, disciplined, and patient approach, any investor has the possibility of identifying and taking advantage of these opportunities. This chapter sets a fundamental principle for any investor: the best investment opportunities might be right in front of you. You just need to be patient, observant, and willing to think long-term. Chapter 3: Apples and Donuts. In this chapter, Peter Lynch uses a simple yet powerful metaphor to explain how to evaluate investments effectively: the comparison between apples and donuts. Through this analogy, Lynch seeks to demonstrate that while analyzing companies may seem complicated and full of technical details, the reality is that what's most important is focusing on the basics and observing what each company does well, just like when choosing an everyday product like an apple or a donut. Simplicity in analysis. Lynch begins by stating that often investors complicate things too much, looking for complex formulas or analyzing details that have no direct relevance to a company's long-term growth and profitability. For him, the best investments aren't found in the most sophisticated products or the most complicated companies, but in those that offer something simple and truly valuable. This is much like how we choose an apple at the market. Quality and value are what truly matter, not the packaging or complexity of the product. The importance of understanding what you're buying. The author stresses that before investing in a company, the investor should fully understand what that company does and how it makes money. Just like when buying an apple, we know it should be fresh and juicy, with a pleasant texture and flavor. Similarly, if you don't understand what a company does, or if you find it difficult to explain in simple terms, that should be a warning sign. The best companies are those whose operations and business models are easily understood. You don't need to be an expert in a specific sector to recognize whether a company is in good shape. Just apply common sense. Why donuts? Lynch uses the example of a donut to refer to companies that seem attractive but lack a solid foundation. Donuts are often delicious and tempting, but we know they aren't nutritious or beneficial for long-term health. In the same way, some investments may look appealing in the short term, but when analyzed more closely, we find they lack the necessary foundation to grow steadily over time. These could be companies that are trendy or offering something flashy but don't necessarily have a sustainable business model or are overvalued. Analyzing the basics. Lynch suggests that, rather than complicating things with technical analyses, investors should focus on what really matters. What does the company do well? And how does it perform in its sector? The key is not in the technology or software the company uses, but in its ability to generate revenue and stay competitive in the long run. This simplicity in analysis is what allows investors to see what others don't and spot opportunities before the market. The power of simplicity. An important aspect that Lynch highlights in this chapter is that investors tend to overcomplicate investment decisions. Many believe that to invest successfully, they must fully understand all the technical aspects of a company or market. However, Lynch emphasizes that the best investments are based on simple principles. Just like an apple is easy to understand, it's a fruit that's grown, harvested, and sold, a good investment should be equally understandable and accessible. Instead of getting dazzled by difficult-to-understand details or figures, investors should focus on what can truly generate long-term value. Practical example: investing in what you know. Lynch encourages investors to look around them and analyze companies they already know, those whose products or services they use in their everyday life. If you like a product, or if you see that people around you enjoy it, that's a clue that the company behind that product might be a good investment opportunity. One example of this is when Lynch started investing in consumer goods companies. By being familiar with the products and seeing their popularity, he could identify that the market for them would continue to grow, making these companies worth considering as an investment option. The importance of business model sustainability. Another key point that Lynch addresses is the sustainability of the business model. Just as we wouldn't spend money on donuts daily because of their lack of nutritional value, we should also avoid investing in companies that are only generating temporary profits or lack a solid business model. A company might have a good product or a great advertising campaign, but if its business model cannot adapt and grow over time, it is not a secure investment. What truly matters is whether the company has something that makes it competitive and able to sustain itself in the long run. Avoiding unnecessary complexity. Lynch also mentions how many investors are drawn to technology companies or investment options that seem sophisticated but are actually poorly understood. Just like donuts may look appealing but don't offer any real benefits, some investments seem exciting because of their complexity, but in reality, they don't offer the value or stability an investor is seeking. Therefore, he recommends avoiding investments that are only on the market due to their complexity or temporary appeal. Conclusion: keep investment simple. The main message of this chapter is that as an investor, you should keep your strategy simple and focused on what you truly understand. If you can describe in simple terms what a company does and how it makes money, then you're likely making an informed and sound decision. Unnecessary complexity only adds confusion and lowers the chances of success. Rather than looking for the next big idea or technology trend, look for companies with clear and solid business models, offering something valuable and understandable. This chapter reinforces Lynch's philosophy that the best investments are often the simplest and easiest to understand. Investments shouldn't be complicated. On the contrary, they should be based on clear principles, grounded in what you know and what truly holds value. Chapter 4. The Power of What Everyone Knows. In this chapter, Peter Lynch explains how the best investment opportunities are often found in what we already know, in things so common that we overlook them. Throughout the chapter, he emphasizes how investors can leverage everyday knowledge and experiences to identify companies with great growth potential. The market is full of obvious opportunities. Lynch begins by stating that one of the main advantages individual investors have is that they often have an edge over professional analysts simply because they live everyday life. If you know what's trending, what's working in the market, or the products that are really being consumed by a large part of the population, you have an advantage. Many times, professional investors are too focused on market fluctuations and statistics to notice what's obvious. The average investor, on the other hand, may be much more in tune with the changes taking place. The power of popular trends. Lynch highlights how large growth companies have often been identified because their products or services became popular among consumers. Companies that sell products or services that people use in their everyday life have a significant advantage. What might seem trivial, like a clothing store becoming a popular hangout or a cereal brand becoming a family favorite, can be an important clue for a potential investment. Invest in what you understand. A key principle for Lynch is investing in companies whose activities you understand. If you're a consumer, if you regularly use a product or service and find it useful, others are likely to share the same opinion. In this way, an investor can base their decision on something as simple as their personal experience with a product. Lynch mentions how he began investing in Pier 1 Imports because he was a frequent customer of the store. He realized that if he enjoyed the shopping experience there, many others probably did too. This type of everyday observation can be an excellent indicator of a promising investment. Practical knowledge and direct observation of what's working is a powerful investment tool. Don't underrate well-known companies. Lynch also mentions how sometimes investors overlook large companies simply because they're too well known. However, companies that already have a solid position in the market shouldn't be dismissed. Often, big brands are stable companies that continue to grow simply because they keep doing well what they've been doing for years. Here, Lynch makes a distinction between investing in a company for its popularity and investing in a company that has a solid competitive advantage, capable of maintaining long-term growth. Practical example, the story of McDonald's. One of the most well-known examples Lynch uses in this chapter is McDonald's. Lynch recalls that he began noticing the popularity and growth of McDonald's through his own consumption and observation of popular culture. McDonald's not only offered cheap and accessible food but was constantly innovating and improving its business model, which allowed it to become a global brand. By observing trends, Lynch realized that McDonald's wasn't just a popular company but was set to grow as more people adopted the American fast food lifestyle. This type of observation was key to his success in investing in the company. Observing consumer behavior. Lynch reinforces the idea that consumers often have more information about the market than financial analysts. By observing consumer trends, we can quickly identify what is working and what isn't. When people repeatedly purchase a product or lean toward a specific brand, this is a clear sign that a company may be positioning itself for sustained growth. The risk of ignoring trends. The author also points out that by ignoring popular trends, investors can miss out on great opportunities. Emerging companies offering something new or solving a common problem often have the potential to be very successful. However, traditional analysts might not notice these trends because they are more focused on the financials of large corporations. Hence, it's important not only to rely on hard data and financial reports but also to pay attention to consumer behavior and the trends shaping the market. Small businesses also have great potential. Lynch also emphasizes that it is not necessary to invest only in large companies. Small businesses can have the potential to be 10-baggers if they offer a product or service that addresses a growing need or a popular trend. For example, if you discover a local store growing due to public demand or a clothing brand that has found a market niche, these small companies may offer extraordinary growth potential. Often, these small businesses are overlooked by large funds, but individual investors can spot their potential. Conclusion: invest in the everyday. The chapter concludes with the key message that everyday knowledge is a powerful advantage when it comes to investing. You don't need to be a finance expert to make good investments. You just need to be aware of what's going on around you and use your consumer knowledge to identify opportunities. What you buy or see others buy can be a clear sign of companies with growth potential. Sometimes, the best investments are closer than we think, and knowledge of what we already use and enjoy can be your biggest advantage when investing in the market. Chapter 5. Is this company public? In this chapter, Peter Lynch addresses one of the most anticipated and exciting moments in the life of any company, the IPO, initial public offering. Companies that decide to go public are opening the doors to the financial market, seeking funding through the sale of shares. Lynch teaches us how investors should evaluate these opportunities and navigate the risks and rewards that come with an IPO. The concept of an IPO. Lynch begins by explaining what an IPO is and why companies decide to take this step. An IPO is the process through which a private company becomes public by issuing shares that can be bought and sold on the market. The motivation for many companies to launch an IPO is to access significant capital that can fund their expansion, research, development, or even pay off debt. However, an IPO also means the company must submit to market scrutiny, comply with strict regulations, and share its financial information publicly. Lynch points out that IPOs have historically been seen as an exciting event full of potential. Investors, drawn by this hype of novelty, often buy shares without fully understanding the company's details, its prospects, or the risks involved. However, according to Lynch, this is a common and potentially costly mistake. The risk of inflated expectations. One of Lynch's main warnings in this chapter is the inflation of expectations that often accompanies IPOs. Since they are such a media event, IPOs generate a lot of attention, and the share prices of these companies can be inflated by the excitement and interest of investors. Lynch explains that, although IPOs can be thrilling and promising, they are often overvalued due to excessive speculation from analysts and the media. When a company goes public, investors tend to have high expectations about its future performance. However, these expectations are not always met. Collective enthusiasm often creates a bubble, and when the share price does not live up to the high expectations, investors can lose money. Lynch cites several IPOs of popular companies that initially seemed promising but ended up disappointing investors as the initial euphoria faded. The importance of research. Lynch emphasizes that before jumping in to buy shares of a company that has just gone public, investors must do their own research. It is not enough to read the headlines or follow financial analysts' recommendations. It is crucial that investors understand the company's business model, growth prospects, competition in its sector, and, most importantly, the management team leading the company. Lynch suggests that the individual investor has a unique advantage here, as they can apply their common sense and market observation to judge whether a company has a product or service that can truly stand out in the long run. Additionally, when doing their research, the investor should look for companies with a clear competitive advantage, those that are not just popular at the time of their IPO, but have a solid foundation and a business plan that will allow them to grow steadily over the long term. Companies with an innovative product, a strong corporate culture, and a scalable business model tend to have a more promising future than those that rely on current trends. The IPO cycle, expectations and results. Lynch explains that, in many cases, an IPO starts with a large stock sale, which causes the share price to appreciate quickly in the first days or weeks. However, this doesn't guarantee that the company will be successful in the long term. The initial euphoria can obscure the challenges the company will face once it's fully listed and under constant scrutiny from analysts and shareholders. Lynch also observes that volatility is common in the first few months after an IPO. Investors who buy early, driven by excitement, may quickly sell if they see the stock price drop, leading to significant fluctuations in the market. This behavior can be harmful to those who don't have a long-term approach or aren't willing to wait for the company to truly prove its worth. The importance of patience. One of the key lessons of the chapter is that successful IPOs require patience. Lynch advises that investors should not rush to buy in the first few days after the IPO. Instead of joining the excitement, they should wait for the company to stabilize and allow investors to assess its long-term performance. Often, great opportunities do not arise immediately but need time to prove themselves as profitable. Lynch also shares examples of some of his own IPO investments, where he initially did not buy the shares due to their initial overvaluation. However, after waiting and observing how the company performed in the market, he decided to invest when the price stabilized and the company's prospects became clearer. This calmer and more thoughtful approach turned out to be much more profitable in the long run than being swept up by the initial frenzy. Companies with a bright future. Throughout the chapter, Lynch mentions how even in IPOs, there are companies that successfully prove their value in the market and offer extraordinary returns. Home Depot is a prominent example. Although it wasn't the most talked about IPO at the time, the company showed sustained growth by taking advantage of an expanding market and maintaining a solid business model. Companies with these attributes are the ones that really have the potential to provide long-term returns. The long-term approach. Finally, Lynch emphasizes that the best investments are not found in the excitement of IPOs but in the ability to find companies that are well-positioned to grow steadily over time. The secret isn't to buy the hot product of the moment, but to identify companies with the best prospects for the future and have the patience to allow their true potential to reveal itself. Conclusion: a cautious approach to IPOs. Lynch concludes the chapter by saying that while IPOs can be tempting, they should be approached with caution. True success does not come from short-term speculation but from deep research, patient observation, and the ability to identify companies with solid business models. By doing this, investors can take advantage of the opportunities that IPOs offer, but always with a long-term focus and avoiding the frenzy that often accompanies these offerings. This chapter provides valuable insight on how to navigate IPOs wisely, avoiding the traps of inflated expectations and excessive excitement, and focusing on the true value of the company and its long-term growth potential. Chapter 6. Compiling the Gigahertz. In this chapter, Peter Lynch introduces a different approach to investing and discusses how technology and innovation have changed the landscape of investment opportunities. The title of the chapter, Compiling the Gigahertz, refers to the speed at which technologies advance and how investors need to adapt to this pace to find opportunities in the market. The impact of technology on investments. Lynch explains how technology has profoundly altered the market and the dynamics of businesses. In particular, the tech sector has been one of the most disruptive, creating new investment opportunities but also presenting significant challenges. The acceleration in technological development, represented by the constant improvement in gigahertz, a measure of processor speed, has allowed innovative companies to stay ahead and change the rules of the game in their industry. The chapter addresses how to identify tech companies and how investors can leverage innovations such as computing and telecommunications to make more profitable investments. Lynch's goal is to convince investors that it's not necessary to be a tech expert to identify the companies that will dominate the market in the future, but it is crucial to have a basic understanding of the technological trends that are driving change. Technology accessible to everyone. Lynch highlights that it's not necessary to be a technician or an engineer to understand how technology works. As technology becomes more accessible, investors can leverage their everyday knowledge to identify opportunities. If you come across a new technology or an advancement that improves daily life, it's likely that others will also find it valuable, and this can be an indication that there's an investment opportunity behind that innovation. The author also points out that, although technology has changed the pace and structure of the market, the fundamental principle of investing in what you know remains crucial. If a technology or product seems interesting and useful to you, it is likely that it has a broader audience who will value it in the same way. Tech companies on the radar. In the chapter, Lynch uses examples of tech companies that took advantage of technological advancements to transform their industries. Companies like Apple and Microsoft are mentioned as examples of companies that identified the opportunities that new technologies could offer and knew how to adapt and leverage these innovations to achieve success. These examples reinforce the idea that it's not necessary to be a technology expert to identify companies with strong potential. Lynch also highlights how tech companies often have the ability to scale quickly, which can generate huge returns for investors. The exponential growth of companies that manage to create an innovative product and meet a global need is a common phenomenon in the tech sector. By being able to increase production and distribution without a proportional increase in costs, these companies can generate large profit margins. The dilemma of investing in technology. However, Lynch also warns about the dilemma of tech investments. The speed at which the tech sector evolves can be both an advantage and a challenge. While some companies manage to stay ahead of innovation, others quickly fall into obsolescence. This means that investors must be especially careful when investing in tech companies, as trends and fashions change quickly. To avoid risks, investors should look for companies with solid fundamentals and a proven ability to adapt to change. Lynch also emphasizes that the evaluation of tech companies should not always be based solely on financial figures. Sometimes, what makes the difference is the innovation and the long-term vision a company has for its sector and how it can leverage technology to stay competitive. How to identify good tech investments. Lynch offers some tips on how to identify the best opportunities in the tech sector. Understand the product or service. It's not necessary to be a technical expert, but it is important to understand the product or service the company offers and how it has the potential to change its sector. Observe the competition. Evaluate whether the company has a clear competitive advantage or if it's at risk of being displaced by more innovative competitors. Evaluate the sustainability of the business. In the case of technology, it's not just about a bright idea, but about how the company plans to monetize its product and remain profitable in the long term. Practical example: Microsoft. One of the examples Lynch uses is Microsoft, which in its early days not only had innovative technology but also a clear focus on dominating the operating system market. While competition was rising and many saw opportunities in other technologies, Microsoft was able to establish itself as a leader because it understood users' needs and had a solid strategy to scale its business. The rapid cycle of technology. Lynch also points out that the tech sector is particularly dynamic, which can lead to both great rewards and great risks. While disruptive technologies have great potential, they also carry risks, as what is innovative today can be obsolete tomorrow. For investors, this means they must be in a constant learning mode and keep a close watch on the market to identify the next big trends before others do. The author reminds us that the best tech opportunities do not always come with big promises of immediate profits but with long-term innovations that have the potential to transform entire industries. Investors must be aware of this fast cycle and be willing to adapt. Conclusion: don't fear technology. At the end of the chapter, Lynch concludes that investors should not fear technology. While the sector can be complex and constantly evolving, the opportunities for those who have patience and observe trends correctly are enormous. Furthermore, it's not necessary to be a technical expert to identify the right opportunities. What matters is applying common sense, conducting proper research, and having a long-term vision. If a company has a truly innovative product that people want, it is likely positioned for substantial growth, making it an excellent opportunity for investors who can recognize it. This chapter emphasizes that technology is a sector that, if approached correctly, can generate significant benefits for investors willing to take the time to understand it and identify the companies with the greatest potential. Chapter 7. A Pest in the Cabbage Patch. In this chapter, Peter Lynch talks about the risks of investing in companies you don't understand or that are too overvalued. He uses the metaphor of a pest in the cabbage patch to illustrate how certain sectors or companies can seem promising but, when analyzed in more detail, reveal fundamental flaws that can be detrimental to the long-term investor. The danger of fads. Lynch begins the chapter by discussing how certain market fads can attract investors to companies that initially seem like a promising opportunity but are actually poorly positioned for long-term success. The pest in the cabbage patch is a metaphor that refers to how a company, or even an entire sector, may seem healthy and promising, but upon closer inspection of its fundamentals, structural flaws are revealed that can lead to its downfall. Throughout the chapter, Lynch emphasizes that, as investors, we must be cautious of passing fads and not get carried away by trends without conducting thorough research. Companies that seem to be the latest craze in the market can turn out to be a poor investment if they lack a solid business model, a clear competitive advantage, and the ability to adapt. How to spot a pest in the patch. Lynch details some key characteristics that can help investors identify companies with pests in their operations. These are some of the warning signs. Lack of profitability. Companies that do not generate profits or rely on large external investments to survive are a red flag. While some companies may be profitable in the long term, many times fad-driven companies spend more than they earn while chasing a future promise that rarely materializes. Excessive debt. Companies that are overly indebted to finance their operations or expansions may face long-term problems, especially if the market changes or they face an economic downturn. Incompetent or overconfident management. A lack of effective leadership or a management team that doesn't know how to handle a crisis or respond to market changes is a clear indication that a company could be in danger. Lynch also discusses how the arrogance of executives can lead to poor decision-making. The impact of tech fads. Lynch also addresses how the tech sector can be particularly exposed to these pests. While technology holds enormous potential, the market is often overheated with the arrival of new fads, leading investors to bet on companies that seem promising on the surface but lack the necessary foundations to sustain long-term growth. Often, tech companies that don't have a unique product, aren't well positioned in their niche, or don't offer real solutions to specific problems can become a pest in the investment patch. The value of independent research. Lynch emphasizes the importance of not blindly following analysts' recommendations or getting swept up in market fervor. While analysts may do their job professionally, they often focus too much on the surface of a company, such as its latest quarterly earnings or short-term growth forecasts. Lynch advises investors to conduct their own research and evaluate not just a company's finances, but also its business model, product quality, and ability to remain competitive. The importance of understanding the sector. For Lynch, one of the most effective ways to avoid pests in the investment patch is to have a solid understanding of the sector in which you are investing. It's not enough to know that a company is trendy or has a large user base. An investor must be able to explain why the company is competitive, how it differentiates itself from its rivals, and what its sustainable competitive advantage is. If a company lacks a clear advantage, or if its sector is saturated with competition without a clear path to success, it may be better to avoid it. The problem of unrealistic expectations. Lynch also points out that many fad-driven companies create unrealistic expectations about their future performance. Investors drawn to the new wave of an industry or technology may expect a company to grow exponentially, without considering the risks involved or the obstacles the company faces. This mindset can lead investors to make speculative bets instead of investing in companies with a sustainable future. Practical example: the pests of consumer companies. Lynch mentions that, in the world of consumer companies, there are examples of businesses that seemed promising due to the momentary popularity of their products but failed to sustain that success due to poor management or a lack of continuous innovation. An example of this might be a clothing or tech brand that, due to its initial popularity, saw a surge in its stock price, only to later experience a sharp decline when the company failed to adapt to market changes or competition. The importance of patience and discipline. For Lynch, patience is key. Companies with a solid business model and good management do not have to rely on momentary popularity to generate sustainable income. In fact, the best investments are often those that grow steadily and consistently without relying on passing fads. Investors should be disciplined and wait for companies to prove their long-term value, rather than seeking quick profits from companies based on trends. Conclusion: don't get caught by the pests. In conclusion, Lynch warns investors not to get carried away by market excitement or current fads. Pests in the investment patch are inevitable, but with patience, discipline, and research, investors can avoid falling into them. The true value lies in companies with solid fundamentals and a long-term vision. If a company is overvalued or lacks a sustainable business model, it is likely to be a pest that will eventually devour investors' profits. This chapter underscores the importance of maintaining a cautious, thoughtful approach grounded in the fundamental principles of company analysis to avoid falling into the traps of market fads. Chapter 8: How to Become an Investor. In this chapter, Peter Lynch talks about how to become a good investor, providing practical advice based on his experience. Lynch discusses the importance of understanding the investment process and adopting the right mindset to make informed and wise decisions. Throughout the chapter, he offers tools and strategies for those looking to improve their investment skills and learn how to identify opportunities in the market. The disciplined approach. Lynch begins the chapter by emphasizing that a good investor is not someone who is lucky, but someone who makes decisions based on disciplined, well-founded analysis. Discipline is key to avoiding the emotional traps of the market, such as euphoria or panic, which can lead to hasty or incorrect decisions. To become a good investor, it is essential to have a systematic and rational approach to investing. Lynch reminds us that investments should be based on facts, analysis, and long-term forecasting, not impulsive reactions or external influences like rumors or passing fads. The value of patience and consistency. Lynch highlights that one of the main ingredients for success in investing is patience. Investments don't always bear fruit immediately, and for a time, you may see price fluctuations or even losses. However, the key to success is staying calm and waiting for the company to develop and grow over time. For Lynch, a successful investor knows that, rather than trying to predict the market in the short term, they should have a long-term perspective and be willing to hold their investment even when things don't look favorable in the moment. Lynch uses the example of companies like Home Depot and Ford, which, although not the most popular or widely discussed in their respective markets, grew steadily due to their solid and disciplined approach. By maintaining patience, investors who supported these companies long-term achieved great returns. Learning to manage risks. Another key aspect that Lynch addresses in this chapter is the ability to manage risk. Every investor must understand that no investment is risk-free, and it is essential to know how to manage it properly. Lynch emphasizes that a good investment is not just one that promises high returns, but also one with controlled risks. Lynch advises investors to diversify their portfolios to reduce risk and focus on companies that, although they may have certain risks, have a strong business model and competent management team. While risk is inevitable, a disciplined and well-informed investor can mitigate those risks by making informed decisions and carefully evaluating the companies they invest in. The power of ongoing research. Lynch also emphasizes the importance of continuous research. A good investor never stops learning. Lynch points out that the key to improving as an investor is being willing to constantly research companies, read about new sectors, and stay updated on market trends. As the market and companies change, an investor must adapt to those changes and be proactive in their financial education. Throughout his career, Lynch dedicated much time to researching companies, reading reports, and talking to CEOs to better understand the businesses he was investing in. This approach allowed him to have an advantage over other investors who did not take the time to truly understand what they were buying. Ongoing research is what sets successful investors apart from those who get carried away by emotions or speculation. It's not about being a genius. Lynch stresses that you don't need to be a genius or an expert in finance to be a good investor. In fact, many of the best investors are people who use simple, straightforward approaches to make informed decisions. The true talent doesn't lie in making complex predictions about the market, but in doing simple, logical analysis that can offer real long-term value. Lynch reminds us that the best investments often come from basic principles. Invest in what you understand, be patient, and remain calm amid volatility. There's no need to complicate things. The biggest opportunities can be found by observing and analyzing companies operating in sectors you understand well and evaluating their ability to grow steadily in the future. Learning from failures. A recurring theme in the chapter is the importance of learning from failures. Lynch explains that even the best investors make mistakes, but the key is to learn from them and not let failures negatively affect future decisions. Instead of feeling defeated by a failed investment, the investor should view each mistake as an opportunity to improve their approach and make better decisions moving forward. Lynch shares examples of his own investments that didn't turn out as expected but taught him valuable lessons about the importance of not overvaluing companies or being carried away by fads. These lessons helped him refine his approach and make more informed decisions in the future. The importance of trusting yourself. One of the key ideas in the chapter is the need to trust your own judgment as an investor. While it is useful to listen to advice and learn from others, Lynch emphasizes that a good investor must be willing to make their own decisions and take responsibility for them. It's not about blindly following analysts or market experts but developing a personal and reliable approach to evaluating investment opportunities. An investor who feels confident in their decisions and is committed to learning from their mistakes will be more successful than one who depends solely on external recommendations. True success comes from confidence in your own analysis and the willingness to take responsibility for your choices. Conclusion: becoming a successful investor. Lynch concludes the chapter by reminding us that success in investing is not about luck but about discipline, patience, research, and the ability to learn from mistakes. A good investor follows a disciplined approach, grounded in solid principles, and remains consistent in their learning process. By being aware of risks, patient, and proactive in their education, anyone can become a successful investor, regardless of their initial experience in the market. This chapter provides a clear roadmap for those looking to improve their investment skills, showing that true success lies in consistency, rational focus, and continuous learning. Chapter 9: The Oxymorons of Wall Street. In this chapter, Peter Lynch addresses the contradictions and misunderstandings surrounding the stock market and investing in general. He uses the term oxymorons to refer to ideas that seem contradictory but, when analyzed in detail, make sense. Lynch explains how these contradictions can offer investment opportunities and how investors can learn to navigate a market full of paradoxes. The optimism versus pessimism dilemma. Lynch starts the chapter by talking about how, on Wall Street, there is often a battle between optimism and pessimism. Analysts tend to be either extremely optimistic or overly pessimistic, which can create a distorted view of the market. According to Lynch, extreme optimism can lead to overvaluation of stocks, while extreme pessimism can cause investment opportunities to go unnoticed. An example of this contradiction is when a company goes through a difficult period and analysts predict its downfall, without considering its long-term business model or its ability to overcome those problems. Lynch explains that as investors, we need to be aware of these emotional ups and downs in the market and look for opportunities during times of pessimism. The market is emotional. Lynch highlights that the market is often driven more by emotions than by logic. People can panic and sell stocks of solid companies due to rumors or short-term bad news, which creates an opportunity for smart investors who are willing to look beyond the volatility. The ability to stay calm and not be swayed by market emotions is one of the main characteristics of a good investor. The contradiction of experts. Lynch also touches on the contradiction between what experts say and what is actually happening in the market. Often, experts do not agree with each other, which can create confusion for investors. However, Lynch points out that while analysts may have valuable information, it is important not to blindly follow their recommendations but to make your own decisions based on independent research. Analysts often tend to predict the future based on past patterns, but the market is full of unpredictable variables, which makes these predictions often inaccurate. Lynch stresses that, as investors, we need to make informed decisions and not base them solely on what others say. If everyone agrees that a company has a great future, it's possible that company has already been overvalued. On the other hand, if the consensus is negative but a company has a solid business model, it could be undervalued and a great investment opportunity. The concept of buy low, sell high. One of the most common oxymorons on Wall Street is the concept of buy low, sell high. While it seems simple and logical, many investors don't follow this principle because they are attracted to stocks that are rising in price, rather than those that are temporarily depressed but have great potential for recovery. Lynch illustrates how investors are often more willing to buy when stocks are at their highest point, driven by market euphoria, and more reluctant to buy when stocks are at their lowest point, due to fear and pessimism. However, the best investors are those who can see opportunities when others are afraid and aren't pressured by short-term fluctuations. Buying when prices are low and selling when they are high remains the fundamental principle for achieving great long-term returns. Excessive optimism in fads. Lynch also points out how market fads can be both an opportunity and a risk. Companies that follow the trends of the moment may seem very attractive, but often they are overvalued due to the excitement they generate. These fads can be very profitable in the short term, but they can also lead to a price bubble that bursts when the market realizes that the demand was not as sustainable as it seemed. For example, in past decades, the dot-com boom led many investors to buy stocks in tech companies without considering whether the business model was sustainable. Many of these companies didn't survive, but others, like Amazon, were able to capitalize on the trend and establish themselves as leaders in their field. Lynch reminds us that fads must be evaluated with caution, and long-term trends are much more valuable than temporary peaks of enthusiasm. Contradictions in stock valuation. Lynch addresses how contradictions often exist in the way stocks are valued. For example, some companies may appear expensive when evaluated using traditional multiples, like the P/E ratio, but if they have strong and sustained future growth, they may still be an attractive buy. On the other hand, companies with very low prices may seem like a good deal, but if their growth prospects are poor or they are losing competitiveness, they can actually be a risky investment. The risk of overconfidence. Another oxymoron is investor overconfidence, especially among those who have had some past successes. Lynch emphasizes that an investor who has had good results may become overly confident in their decisions and start making riskier investments or follow trends without proper analysis. Humility and self-control are essential to continue making good long-term decisions. Complacency can lead to overestimating one's abilities and, ultimately, to significant losses. The value of learning from mistakes. One of Lynch's key lessons in this chapter is that learning from mistakes is fundamental to long-term success. While all investors make mistakes, Those who learn from them and adjust their strategies tend to have better results than those who don't. Mistakes should not be a source of discouragement, but an opportunity to learn and improve future decisions. Conclusion: leveraging the oxymorons. Lynch concludes the chapter by highlighting that, although Wall Street is full of contradictions and paradoxes, a good investor is able to navigate these oxymorons and look beyond the surface. The market may seem emotional, contradictory, and often illogical, but those who remain calm, do their research, and focus on the fundamental principles of investing will find the best opportunities. This chapter teaches that, in a world full of uncertainties and passing trends, the most successful investors are those who remain disciplined, informed, and patient, ready to capitalize on the opportunities that others may overlook. Chapter 10. Is this a casino or what? In this chapter, Peter Lynch discusses the fundamental difference between investing and speculating, and how many investors tend to treat the stock market like a game of chance or a casino. Lynch emphasizes that while the market can be unpredictable in the short term, true investing is based on a deep understanding of companies and a long-term strategy, not luck or chance. Speculation versus investment. Lynch begins the chapter by making a key distinction between speculation and investment. Speculation, according to Lynch, is an act of betting where stocks are purchased in the hope that their price will rise due to external factors such as market rumors, short-term movements, or the temporary popularity of an industry. True investment, on the other hand, involves fundamental analysis of the company, its products, its management, and its long-term growth prospects. Instead of worrying about daily stock price fluctuations, the investor focuses on acquiring shares of companies with solid business models that can generate consistent returns in the future. The problem with the short-term market. Lynch points out that the stock market has a component of chance in the short term. Stock prices can fluctuate due to market news, rumors, or even collective emotion. However, these short-term movements have nothing to do with the true health of a company. Investors need to be careful not to fall into the trap of trying to predict these short-term movements, as the true value of stocks comes from the company's ability to generate long-term profits. Efficient markets may be unpredictable, but a company with strong fundamentals will always have the potential to grow steadily. The casino effect. Lynch mentions that, on many occasions, investors behave as if they were in a casino, buying and selling stocks without truly understanding what they are investing in. This behavior is common when investors try to play the market, expecting their stocks to rise quickly without considering whether the company has a solid business model. The author warns that this approach is dangerous, as short-term fluctuations are not a reliable basis for making investment decisions. Treating the market like a casino can lead to significant losses and emotional mistakes when prices do not rise as expected. The long-term mindset. According to Lynch, the key to true investing is adopting a long-term mindset. When investing in companies with strong fundamentals and a solid business model, short-term market fluctuations should not be a cause for concern. Instead, an investor should focus on the company's growth prospects and how it is positioned to create long-term value. Lynch emphasizes that successful companies tend to grow slowly at first and then accelerate their growth as they reach a larger scale, which generates great returns for patient investors. The role of management in investments. Lynch also stresses that one of the most important aspects of a successful investment is the quality of the company's management team. A good management team can transform an average company into a successful business, while poor management can ruin even the best opportunities. Therefore, it is crucial for investors to pay attention to the structure and experience of the leadership team before making an investment decision. Companies with committed, innovative, and long-term oriented leaders are more likely to succeed than those with mediocre management or a focus solely on short-term profits. The dilemma of cheap stocks. Lynch also discusses a common dilemma among investors: the stock price. Often, investors are drawn to stocks that are cheap in terms of their nominal price, without understanding the true value of the company. A low stock price does not always mean that a company is a good buy, and the same goes for expensive stocks. Lynch warns against the mentality of buying just because stocks are cheap or selling because stocks seem expensive. The real key is to analyze the company's fundamentals and ensure that the stock price is reasonable in relation to its growth prospects and ability to generate earnings. The individual investor's approach. One of the advantages of the individual investor, according to Lynch, is that they are not bound to keep pace with the frantic pace of Wall Street, where decisions are often driven by short-term pressure and market expectations. The individual investor has the freedom to invest in companies that interest them, based on their own judgment, and can hold their investments for the long term without feeling pressured by daily market fluctuations. Lynch points out that, while professional investors must constantly buy and sell stocks to meet their fund's performance targets, individual investors can be more patient and focus on long-term value, which gives them an advantage in achieving consistent returns. The importance of independent research. Lynch also highlights the importance of doing your own research before making any investment decision. Many investors rely on analysts and Wall Street recommendations, but Lynch warns that many of these analysts do not have an in-depth knowledge of the companies they are recommending. The investor who conducts their own research, analyzes companies and their markets, and uses common sense has an advantage over those who blindly follow others' recommendations. The key is to understand what you're buying, how the company works, and its long-term growth potential. Conclusion: rational investment versus speculation. Lynch concludes the chapter by stating that true investing is rational and grounded, not an act of chance or speculation. Investors should focus on companies with solid business models, competent management teams, and sustainable growth prospects. Investing in the stock market is not the same as gambling in a casino. The key is to make informed investments, based on research, patience, and a long-term approach. This chapter reinforces the idea that success in investing does not come from luck or speculation, but from making rational, well-founded decisions that align with deep analysis and a long-term mindset. Chapter 11: How to Pass the Mirror Test. In this chapter, Peter Lynch reflects on the importance of self-discipline and self-evaluation to succeed in the world of investing. He uses the metaphor of the mirror test to discuss how investors must face themselves, recognize their own emotions and biases, and learn to make investment decisions based on logic and analysis, not impulses or emotional reactions. The mirror test: looking at yourself. Lynch begins the chapter with a reflection on what it means to face oneself before making an investment decision. The mirror test is an exercise in self-awareness, where the investor asks themselves whether they are truly making informed decisions or if they are being influenced by emotional factors. Lynch explains that investors must be honest with themselves, especially when it comes to making financial decisions. To be a good investor, it is necessary to have the self-discipline to ignore emotions like fear, greed, and anxiety. Often, these feelings can lead investors to make impulsive decisions, such as selling in panic when the market drops or buying without thinking when prices rise too much. Lynch stresses that investors who control their emotions are the ones who achieve long-term success. The danger of emotionality. Lynch highlights how emotions can cloud investors' judgment. The psychology of the market can be a significant obstacle if not managed properly. Fear can make investors sell at the worst possible moment, while greed can cause them to buy at market peaks when stocks are overvalued. The author also points out how the emotional cycle of the market, with its ups and downs, affects investors, who may feel invincible when the market rises and completely defeated when it falls. Lynch encourages investors to be rational and stick to their investment plan despite the emotional ups and downs. The key to passing the mirror test is learning to make decisions calmly and based on logical analysis, rather than being driven by impulsive reactions or external influences. Recognizing personal biases. A crucial part of the mirror test is being able to identify the personal biases that affect our decisions. Lynch explains that all investors have biases, whether due to past experiences, preconceived beliefs, or even the desire to follow the crowd. The most common bias is confirmation bias, which leads investors to seek information that supports their pre-existing beliefs while ignoring data that might contradict them. The challenge for investors is recognizing when they are being influenced by these biases and correcting the course of their decisions. This requires a great deal of self-criticism and the willingness to learn from mistakes and constructive feedback. An investor who can overcome their biases and maintain an open mind is more likely to make good long-term investments. The importance of patience. Lynch also dedicates part of the chapter to discussing patience, a fundamental quality every investor must cultivate. Investors must be able to wait for the right moment to act, rather than feeling pressured by short-term market movements. Patience is essential to identifying solid companies with the potential for consistent growth, without giving in to the temptation of seeking quick profits. Lynch reminds that the best investments are not always the most exciting or the most popular. Often, the companies that offer steady and stable returns are those that go unnoticed by the market but provide sustained growth over years. Investors who practice patience and have a long-term mindset are the ones who reap the greatest rewards over time. Overcoming losses. The chapter also touches on how investors must handle losses. Losses are inevitable in the investment world, but what differentiates successful investors is their ability to manage losses calmly. Lynch explains that many investors feel defeated after a loss, and instead of learning from the experience, they get caught up in frustration and fear. It's important for investors to learn to accept losses as part of the process and focus on learning from them to improve in the future. Lynch suggests that investors regularly review their portfolios and analyze their decisions, both right and wrong. Learning from mistakes is key to improving as an investor and avoiding repeating the same failures in the future. The impact of emotional decisions. The author also mentions how emotional decisions can negatively affect investments. Emotions can cloud judgment and lead to hasty decisions that are not based on proper analysis. Lynch advises investors to avoid reacting impulsively to market movements and instead follow their investment plan. Often, investors feel pressured by insecurity when markets fall, which leads them to sell their assets at low prices. In other cases, they may be influenced by greed when markets rise, leading them to buy without considering the risks. The key is to remain calm, follow investment principles that work in the long term, and not be swayed by fear or greed. Conclusion: constant reflection. Lynch concludes the chapter by emphasizing that the key to passing the mirror test is self-discipline and continuous self-evaluation. Successful investors are those who face themselves, acknowledge their mistakes, and strive to constantly improve their investment skills. The ability to make investment decisions based on logical analysis, rather than emotions, is what distinguishes successful investors from those who succumb to panic or market euphoria. This chapter is a call for self-awareness and self-education. To be a successful investor, it is essential to develop the ability to make rational decisions and maintain discipline, even in the most uncertain or volatile market times. Chapter 12. Is this a good time to invest? Please don't ask me that question. In this chapter, Peter Lynch addresses one of the most common and difficult questions in the investment world. Is this a good time to invest? Lynch argues that this is one of the wrong questions investors often ask, as the right time to invest does not depend on market fluctuations, but on the specific opportunities that companies present. The market does not have an ideal moment. Lynch begins the chapter by saying that many investors, especially beginners, feel overwhelmed by the question of when the best time to invest is. The problem with this question is that there is no perfect time to invest, as the market is always in constant change. According to Lynch, trying to predict the best time to enter or exit the market is a futile and risky task. Instead of focusing on perfect moments, investors should focus on the companies they are investing in, their fundamentals, and their long-term growth potential. Lynch explains that the stock market is unpredictable in the short term, making attempts to predict market movements nearly useless. Short-term fluctuations do not reflect the true value of a company, and making investment decisions based on these movements can lead investors to make poor choices. Instead of waiting for the perfect moment, Lynch suggests that investors focus on solid companies that have growth prospects, regardless of what the market does in the short term. The long-term approach. The author emphasizes that successful investors adopt a long-term approach. If a company has a solid business model and a competitive advantage, the exact timing of the investment is less relevant than the company's ability to generate long-term value. Markets fluctuate, but a well-managed company with a strong position in its industry and that satisfies a market need will continue to grow over time. According to Lynch, it is more important to maintain discipline and not be swayed by market volatility. Lynch uses the example of McDonald's, which, despite market volatility, continued to grow steadily for many years. The secret to its success wasn't the specific moment in which it was invested in, but its business model and the company's ability to adapt and evolve over time. Investing when you find a good opportunity. For Lynch, the real key is not waiting for the perfect moment, but investing when you find a good opportunity. Investors should look for companies that offer real value and have a positive outlook for the future, regardless of what is happening in the market at that time. This means that a good investor must be willing to act when a company presents a clear opportunity, even if the market is in a phase of uncertainty. Lynch also mentions that often the best times to invest are when the market is fearful or when prospects are uncertain. During these times, well-positioned companies may be undervalued, presenting a great opportunity for investors who are willing to buy with a long-term approach. The cycle of confidence and distrust. Lynch analyzes how the cycle of confidence and distrust affects investor behavior. When markets are booming, investors tend to be overly optimistic, leading to overvaluation of many stocks. On the other hand, when markets are declining or when there is uncertainty, investors tend to be excessively pessimistic, selling stocks without considering the long-term prospects of the companies. The author explains that these emotional market cycles should not influence investors' decisions, as short-term fluctuations do not necessarily reflect the true value of a company. Instead of being influenced by the general mood of the market, investors should make decisions based on the fundamentals of the companies and their growth potential. The importance of patience and perspective. Lynch also emphasizes that patience is essential to being a successful investor. Markets can have ups and downs, and investors may feel tempted to make impulsive moves. However, a long-term perspective is what allows investments to grow. The market can be volatile, but companies with a good business model, a competent management team, and a valuable product have the potential to generate positive returns over the long term. Lynch recommends that investors focus on companies they understand, that have a lasting competitive advantage, and that are well-positioned to face future challenges. Investing in these types of companies, rather than trying to predict the market's peaks and valleys, is the best strategy for building long-term wealth. The trap of following market news. A common trap that many investors fall into is being overly influenced by market news. Headlines, short-term news, and analyst recommendations can lead investors to make impulsive decisions. Lynch points out that, while it is important to stay informed, one should not allow daily news to influence long-term investment decisions. The key is to have a broader view and base decisions on the fundamentals of the companies. Conclusion: stay calm and think long-term. Lynch concludes the chapter by highlighting that the perfect time to invest is when you find a good company with a bright future, not when the market is at its lowest or highest point. The market will always be full of fluctuations, but what really matters is the ability of companies to generate sustained value over time. By adopting a rational approach, focusing on fundamental analysis and long-term growth, investors can overcome the temptation to try to guess the perfect moment to enter or exit the market. This chapter reinforces the idea that true investment success is not based on getting the ideal moment right, but on making informed and patient investments in companies with significant long-term growth potential. Chapter 13: Hunting for the 10-bagger. In this chapter, Peter Lynch delves into the concept of 10-baggers, referring to stocks that increase their value tenfold, or more, from the initial purchase price. This is one of the most coveted goals for investors, as it offers exceptional returns. Lynch explains how to identify and look for these opportunities and how to apply the right approach to find companies with this potential. What is a 10-bagger? Lynch begins the chapter by explaining what exactly a 10-bagger is. It is a stock that increases in value tenfold from its purchase price. These companies do not necessarily have to be the biggest or most well-known, but they have something unique or special that allows them to grow exponentially. The goal of finding a 10-bagger is to identify a company that not only grows, but grows steadily and at a rapid pace. Lynch mentions that finding a 10-bagger is not easy and requires patience, observation, and, above all, deep analysis of the company. While investors may feel like they are searching for a needle in a haystack, Lynch highlights that opportunities are out there and that common sense and thorough research are key to finding these hidden gems. The importance of research. Lynch emphasizes that research is crucial to identifying a 10-bagger. Successful investors are not those who follow market trends or get swayed by rumors, but those who dedicate themselves to researching small or lesser-known companies that have the potential for significant growth. Rather than focusing on large, established companies, Lynch recommends looking at smaller companies that are positioned for explosive growth. The research process includes understanding the company's product or service, its business model, and the market in which it operates. Additionally, it is important to observe the competition and assess whether the company has a competitive advantage that allows it to stand out in the long run. According to Lynch, an investor can find many opportunities in niche markets or companies that are not being closely watched by large investment funds. Characteristics of a 10-bagger. Lynch describes some common characteristics of 10-baggers. Companies with the potential to become 10-baggers usually have a unique or innovative product. Companies that offer products or services that solve major problems or have a technological advantage are often well-positioned for rapid growth. Belong to an expanding industry, 10-baggers are often part of sectors that are experiencing rapid growth. Industries that are emerging or still have a lot of room to grow are ideal places to find these opportunities. Have competent leadership. A strong management team is crucial for a company to succeed. Companies with visionary leaders who can execute a long-term strategic plan are more likely to be 10-baggers. Are undervalued by the market. The best opportunities are not always the ones that are in vogue. Often, 10-baggers start out being underestimated by the market and don't attract attention until they've already begun to grow. The role of patience. Lynch underscores that while finding a 10-bagger is exciting, patience is key. Companies that grow rapidly do not do so overnight. Often, the path to a 10-bagger is long and filled with ups and downs. Investors must be willing to hold onto their stocks for an extended period without being swayed by short-term market fluctuations. Lynch uses the example of Ford in its early years. Despite obstacles, the company grew significantly as it expanded its market and improved its products. 10-baggers are not instant successes, but companies that grow steadily over time, and this requires patience. The role of risk. While 10-baggers can offer extraordinary returns, they also come with significant risks. Lynch highlights that companies with great growth potential are often more volatile and more susceptible to changes in the market. However, risk should not lead investors to completely avoid these types of investments. Instead, they should be smart and calculated, evaluating both the growth potential and the risks involved. Lynch recommends that investors not put all their money into a single company, even if they believe it has the potential to be a 10-bagger. Diversification remains a key strategy to mitigate risk. Avoiding common traps. Lynch also mentions some common traps that investors can fall into when searching for 10-baggers. One of them is following trends. Investors are often attracted to companies that are trendy, but this does not always mean those companies are the best investment opportunities. Often, popular stocks are already overvalued, limiting their growth potential. Another trap is investing in companies with an unsustainable business model. Some companies may seem exciting on paper, but if they do not have a lasting competitive advantage or if their business model is not solid, they are unlikely to sustain long-term growth. The value of perseverance. Lynch concludes the chapter by reminding readers that while finding a 10-bagger is a difficult task, perseverance is essential. Successful investors are those who stay focused on their strategy, research diligently, and are willing to hold their investments long-term. There are no guarantees of success, but those who carefully seek opportunities and remain patient and disciplined have a higher chance of finding these hidden gems. This chapter reinforces the idea that 10-baggers are not easy to find, but they are within reach for those who have a systematic approach, thoroughly research companies, and remain committed to their long-term investment plan. Chapter 14. I've got it. What do I have? In this chapter, Peter Lynch analyzes the process of identifying and evaluating an investment that seems promising but is often not fully understood. The title of the chapter reflects the excitement that many investors feel when they identify a stock that seems to have great potential. However, Lynch warns that the real key is not just having a stock that has gone up, but understanding what you actually have and whether the investment has a solid foundation to grow in the long term. The excitement of discovering a promising investment. Lynch begins the chapter by highlighting how many investors, after finding a stock that spikes or seems to be a great opportunity, experience a feeling of excitement. This enthusiasm can make the investor feel as though they've discovered something important, but Lynch stresses that the real key is understanding whether the investment truly has the potential to grow sustainably or if it's just a temporary fluctuation. Lynch explains that when finding a stock that goes up, many investors are drawn to the thrill of immediate profitability without considering whether the company has the solid fundamentals to sustain that growth. A good investor must be able to distinguish between a temporary rise in a stock and the sustained expansion of a company. The importance of fundamentals. Lynch emphasizes that the key to evaluating an investment is not emotionality or short-term price movements, but the fundamentals of the company. These fundamentals include profitability, management, consistent growth, and the company's competitive standing within its industry. Ensuring that a company has a strong and sustainable business model is crucial to determining whether you truly have a good investment. A common mistake investors make is buying stocks based on emotion or market hype without delving into the analysis of the fundamentals. Lynch explains that, rather than focusing on short-term price movements, investors should concentrate on what really makes a company strong and capable of consistent growth. Key questions to ask before buying. Lynch suggests that investors ask themselves a series of key questions before investing in any company. These questions help ensure that the investment is based on a deep understanding of the company, rather than temporary excitement or inflated market expectations. Some of these questions include: how does the company make money? What is its competitive advantage? Is the company in a growing sector? Does it have competent leadership committed to long-term success? Is the company capable of generating sustainable profits, or is it just benefiting from a temporary boom? If an investor cannot answer these questions clearly, they may be investing without truly understanding what they are buying. The importance of not following that hype. Lynch also addresses the issue of hype in the market. Many times, companies benefit from overexposure in the media or a passing trend, which generates hype around their stocks. However, this enthusiasm can be misleading, as companies that are popular may not have the solid fundamentals to support them long-term. Lynch stresses that in these cases, the investor must be particularly cautious and ensure that the company has a true competitive advantage and a sustainable business model. The author recommends that investors focus on undervalued companies with the potential for sustained growth, rather than chasing those in the spotlight, as market trends can quickly disappear, leaving investors with losses. The lesson of the dot-com boom. Lynch reflects on the dot-com bubble of the late 1990s, when many tech companies were overvalued due to market excitement and speculation. Many of these companies did not have a clear or sustainable business model, but they were driven by market euphoria. As a result, when the bubble burst, many investors lost large sums of money. Lynch uses this example to warn investors about the dangers of following the crowd and buying during periods of excessive optimism. While opportunities in emerging sectors, like technology, can be profitable, it is essential for the investor to understand what they are buying and not be carried away by collective excitement. The importance of diversification. Lynch also mentions that a key aspect of staying safe in the world of investments is diversification. While 10 baggers are the goal for many investors, it's important not to put all your eggs in one basket. Diversifying your investment portfolio allows investors to mitigate the risk of losing large amounts of money if one company does not perform as expected. At the same time, Lynch emphasizes that diversification should not be so extreme that it dilutes the potential of 10 baggers. Instead, he recommends maintaining a balanced portfolio that contains companies with strong fundamentals but also has the potential to become 10 baggers as they develop. The importance of patience. One of the key takeaways from the chapter is that patience is fundamental for investors. While finding a 10-bagger can be exciting, Lynch reminds us that true success does not come from quick profits but from the sustained growth of a company. Successful investors are those who hold their investments long-term, even when the market is volatile, and remain focused on the fundamentals of the companies. Lynch emphasizes that while the process of finding a 10-bagger can be long, patience will be rewarded as companies with a solid business model expand and grow over time. Conclusion: understanding what you have. The chapter concludes with an important lesson. It is vital to understand what you have before making an investment decision. It's not just about buying stocks in popular companies or exciting sectors, but about deeply understanding how the companies make money, what their competitive advantage is, and what makes them unique in the market. The best investments are those backed by solid analysis and a clear understanding of the company, its industry, and its growth potential. This chapter reinforces the idea that, in the world of investing, it's not about following the crowd but making informed and grounded decisions based on the fundamentals of the companies. Chapter 15. The Perfect Value, What a Deal! In this chapter, Peter Lynch explores the concept of the perfect value and how many investors fall into the trap of seeking the ideal investment that combines all the desirable aspects: low price, high growth potential, and low risk. Lynch points out that while the concept of perfect values might sound appealing, in practice, it is rare to find an investment that meets all these characteristics. The chapter is dedicated to teaching investors how to realistically assess what a good value is and how to make decisions based on solid fundamentals, even if it's not the perfect investment. The search for the perfect investment. Lynch starts the chapter by noting that many investors embark on the search for the perfect investment, one that has an extremely low price, almost unlimited growth potential, and minimal risk. However, Lynch emphasizes that this type of perfect value rarely exists and that perfection in investments is an illusion that can lead investors to make poor decisions. Lynch warns that in trying to find the perfect stock, many investors lose focus on what truly matters: the solid fundamentals of a company and its ability to generate long-term growth. While it may be tempting to seek an investment that combines all the ideal aspects, successful investors learn to be realistic and focus on opportunities that genuinely have long-term value, even if they don't meet all the perfect criteria. Value versus price. One of the key lessons of the chapter is the difference between value and price. Lynch points out that while it may be tempting to buy stocks that seem cheap compared to their historical price or competitors, this doesn't always mean they are a good investment. The price of a stock does not always reflect its real value or its long-term growth potential. Lynch stresses that stock prices are influenced by various factors, including market emotions, rumors, and news. However, the true value of a company depends on its business model, its ability to generate sustainable profits, and its competitive advantage. Therefore, investors should focus on assessing a company's real value rather than just its short-term market price. Seeking reasonable value. Lynch suggests that instead of searching for the perfect investment, investors should focus on finding companies that are undervalued relative to their true value. This approach focuses on identifying opportunities where the market has overlooked the true potential of the company. The key is not to buy the cheapest stock, but to find a stock that is below its reasonable value and has long-term growth potential. The author also mentions that companies with reasonable prices, rather than extremely low prices, are more likely to generate sustainable returns. Companies that are too cheap or cannot generate profits are often signals of higher risk, whereas those that are slightly undervalued can be the most valuable investment opportunities. Market expectations. Lynch explains that market expectations can be a crucial factor when determining the value of a stock. Companies in popular or trendy sectors often have their stocks overvalued, as investors are driven by excitement and emotion. On the other hand, companies in less popular sectors may be undervalued due to widespread pessimism or a lack of market attention. Lynch emphasizes that intelligent investors must be able to distinguish between market trends and companies with long-term potential. Sometimes, the best investment opportunities are found in companies that are off the radar or not widely followed by major analysts but have a solid business model and growth prospects that the market has not yet recognized. Risk and return. Lynch also points out that every type of investment carries inherent risk, and investors must be aware of the risks before making a decision. There is no such thing as a risk-free investment, but the goal is to manage that risk effectively. The concept of perfect values is often associated with low-risk, high-return stocks, but Lynch warns that, In practice, achieving high returns generally involves accepting a reasonable level of risk. One important aspect Lynch mentions is that investors must learn to measure risk not only in terms of stock price volatility but in terms of the probability that the company can remain successful in the long term. Sometimes, the risk of an investment is not immediate, but rather arises as a company faces challenges or loses its competitive edge. The importance of flexibility. Lynch also discusses the importance of flexibility when investing. Sometimes, what seems like a promising investment may not meet long-term expectations. In such cases, investors must be willing to change their approach and adjust their portfolios based on new information or developments. Flexibility allows investors to adapt to changes in the market or within companies, which increases their chances of long-term success. Conclusion: don't seek perfection. Lynch concludes the chapter by stressing that perfect value doesn't exist, and investors must learn to be realistic with their expectations. Rather than searching for the perfect stock, investors should focus on companies with solid fundamentals, long-term growth potential, and a reasonable price relative to their true value. Success in investing does not depend on finding the perfect stock, but on learning to identify valuable opportunities based on sound analysis and a long-term approach. This chapter reinforces the idea that the best investments are not the ones that seem perfect on paper, but those that have reasonable value and good growth potential, even if they don't meet all the ideal criteria set by investors. Chapter 16. Values to avoid. In this chapter, Peter Lynch shares his perspective on the stocks and values that investors should avoid. Throughout his career, Lynch has learned to identify certain types of companies and sectors that tend to be risky or that do not have the potential to generate sustainable returns. The chapter is dedicated to helping investors avoid common traps and focus on companies that are truly worth investing in. The danger of trendy companies. Lynch begins the chapter by addressing the danger of investing in trendy companies. These companies, while they may experience rapid growth in the short term, are often overvalued due to market enthusiasm. Investors tend to buy these stocks just because they are being widely discussed or because everyone seems to be buying them. However, Lynch points out that trendy companies usually lack a lasting competitive advantage, and in many cases, their prices are inflated without a solid basis to support that value. Lynch recommends being skeptical of market trends and evaluating a company's fundamentals before deciding to invest. Companies that are popular at the moment do not always translate into good long-term opportunities. Enthusiasm may cause prices to rise too quickly, but without a solid business model, these companies are unlikely to sustain their growth. Companies with excessive debt. Another type of company Lynch recommends avoiding are those with excessive debt. While some companies may be effectively financed through debt, Lynch warns that a high level of debt can put a company at risk, especially when interest rates rise or the market enters a recession. Companies that rely on debt to finance their operations are vulnerable to changes in market conditions and may face financial difficulties if they do not generate enough revenue to meet their obligations. The author suggests that investors focus on companies with a more stable capital structure, which do not rely excessively on debt to operate. Companies with high levels of debt are at a higher risk of insolvency, which can lead to a decline in the value of their stock. Companies with unstable business models. Lynch also talks about companies that have unstable business models or operate in highly competitive sectors without any distinctive advantage. Companies that cannot differentiate themselves from their competitors or lack a clear value proposition are often doomed to struggle to remain competitive, limiting their ability to generate sustainable profits in the long run. According to Lynch, investors should avoid companies that do not have a clear competitive advantage. Whether through innovative products, competitive pricing, or a unique business model, a company must have a reason to exist and excel in its industry. Without a competitive advantage, the company will likely be unable to maintain its market share and profitability in the future. Companies dependent on trendy fads. Another type of stock that Lynch warns about are companies that depend on temporary trends. This includes companies based on products that are popular for a short period of time, such as certain consumer fads, trendy technologies, or seasonal products. Although these companies may experience a surge in sales and stock prices, their success is rarely sustainable in the long run. For example, in the past, there were companies that greatly benefited from the popularity of certain technological products. But once those products were replaced by new innovations, these companies saw their revenues and stock prices plummet. Lynch recommends avoiding companies that do not have a solid foundation or that rely on passing fads to stay relevant in the market. Companies with overly optimistic projections. Lynch also advises avoiding companies whose growth forecasts are extremely optimistic. Often, financial analysts and company executives project very high growth rates to attract investors, but those projections are not always realistic. When a company promises exorbitant growth but lacks the fundamentals or the capacity to meet those expectations, the stock can become overvalued. Lynch suggests that investors be cautious with companies that present unrealistic growth projections. It is better to be conservative in estimates and focus on companies that show consistent and realistic growth, rather than follow those that promise extraordinary results without a solid foundation to achieve them. Companies dependent on a single source of income. Lynch warns that companies relying on a single source of income are risky. If a company depends heavily on just one product or service, any change in demand or competition can have a devastating impact on its profitability. It is important for companies to have diversification in their income sources to ensure that they are not dependent on just one factor for their success. Diversified companies, operating in multiple markets or with a portfolio of products, are more likely to withstand market fluctuations and changes in demand. Companies that have not diversified their income base are more vulnerable to external risks. The temptation to follow the crowd. Lynch also mentions the temptation to follow the crowd. Many investors feel pressured to buy stocks of companies that are widely recommended or have extensive media coverage. However, these stocks may be overvalued and not good long-term investments. Investors must learn to think for themselves and not be swayed by market enthusiasm or general consensus. Conclusion: be selective in investments. Lynch concludes the chapter by reminding investors that the key to success is being selective and having a critical mindset. Not all companies have the potential to be great investments, and it is crucial to avoid those with weak business models, those that depend on passing fads, or those burdened with debt. Proper research, focusing on solid fundamentals, and patience are the essential ingredients for finding the right opportunities. This chapter reinforces the idea that investors must be prudent and not be carried away by market emotions, but instead make decisions based on sustainability and the long-term value of companies. Avoiding certain types of companies and stocks can be just as important as finding good investment opportunities. Chapter 17: Profits, Profits, Profits. In this chapter, Peter Lynch explains the importance of focusing on a company's profits when evaluating an investment. Often, investors become obsessed with stock growth, stock prices, or future projections without paying enough attention to the basics, whether the company is generating consistent profits. Lynch emphasizes that companies that are profitable are more capable of generating long-term value, while those without a solid profit base are unlikely to stay afloat over time. The key: sustainable profits. Lynch begins the chapter by highlighting that a company's net profit is a key indicator of its financial health. If a company is not generating profits consistently, it doesn't matter what the market or analysts say about its growth potential. Companies that cannot generate profits do not have the ability to reinvest in the business, pay their shareholders, or survive market challenges. Lynch emphasizes that investors should look for companies that generate solid and sustainable profits, not those that are only booming due to growth expectations without real fundamentals. Profits are the heart of a long-term investment, as they are the engine that allows the company to thrive and shareholders to receive returns. The importance of earnings per share, EPS. A key indicator Lynch recommends considering is earnings per share, EPS. This ratio shows how much profit a company generates per outstanding share and is crucial for determining whether a company is being efficient in generating profits. A growing EPS over time generally indicates that the company is performing well and is able to steadily increase its profits. Lynch also notes that investors should analyze the consistency of the profits. It's not just about an exceptional profit in one quarter but about steady growth over several years. Companies with erratic profits or that experience large fluctuations are not ideal, as this reflects a lack of stability, which can pose risks for investors. Profit margin evaluation. Lynch recommends paying attention to a company's profit margins, as these reflect the company's efficiency in managing its costs and generating profits from its revenues. Profit margins are a good measure of the company's competitiveness within its sector. Companies with high and sustainable profit margins generally have a competitive advantage, as they can generate more profit per unit of sale. Lynch explains that investors should be alert to any changes in profit margins, as a sudden decrease could indicate that the company is losing efficiency or facing competitive pressures. Companies with stable or growing margins are safer for long-term investors, as they show solid management and a strong position in their industry. The problem with non-profitable companies. Lynch also dedicates part of the chapter to companies that lack profits. Often, investors are drawn to companies that are in an expansion phase or that promise significant growth in the future but are not yet profitable. Lynch warns that, although some tech companies or startups may seem exciting, investing in companies without consistent profits is risky. If a company is not generating profits, it cannot produce returns for its shareholders or finance its own growth. While some companies may eventually start generating profits as they expand, there is no guarantee this will happen. According to Lynch, it is much safer to invest in companies that are already profitable and have a stable history of profits. Profit growth. Lynch explains that profit growth is one of the most important factors when evaluating a company. Profit growth is a sign that the company is expanding its market, increasing its customer base, or improving its operational efficiency. Companies with consistent profit growth generally have a solid strategy and competent management that allow them to adapt to market changes and continue generating revenue sustainably. Lynch recommends that investors look for companies that show consistent profit growth over an extended period, ideally 5 to 10 years. Profit growth is not always linear, but companies with a consistent growth pattern over the years are the ones with the highest potential for long-term success. The role of profits in company valuation. Lynch also touches on how profits affect a company's valuation. A key factor in evaluating a stock price is the price-to-earnings ratio, P/E. This ratio measures how much the market is willing to pay for each unit of profit a company generates. Although a high P/E may reflect a high-growth company, Lynch warns that an extremely high P/E may indicate that market expectations are overly optimistic and the stock is overvalued. It is important for investors to use the P/E ratio in conjunction with other indicators, such as profit margins, profit growth, and the financial strength of the company, to get a more complete picture of its true value. The danger of ignoring profits. Lynch concludes the chapter by warning that many investors focus on superficial aspects of the market, such as stock price movements, rumors, or market fads, without considering what's most important, whether the company is actually generating profits. Ignoring profits and focusing only on short-term speculation can be very harmful to long-term investors. The author reaffirms that the key to successful investing is focusing on companies that generate solid and consistent profits, have a stable business model, and predictable growth. Investing in profitable companies with ongoing growth is the best strategy for achieving sustainable long-term returns. Conclusion: profits are the core of investment. Lynch concludes the chapter by reminding investors that, ultimately, profits are the foundation of any solid investment. While other factors like sales growth, innovation, and competitiveness are important, profits are what truly matter when evaluating a company's long-term success. Investors should focus on companies that have consistent profits, a solid business model, and a promising future, without being swayed by market trends or short-term fluctuations. This chapter reinforces the idea that solid and sustainable profits are the main factor in determining a company's true value, and investors should prioritize investments in profitable companies to ensure long-term success. Chapter 18. The 2-Minute Routine. In this chapter, Peter Lynch shares one of his key practices for being a successful investor, the 2-minute routine. The idea behind this approach is that it is not necessary to spend hours and hours analyzing the markets or companies to be a good investor. Instead, Lynch believes that with a quick inspection and the use of simple and effective criteria, Investors can make informed decisions in just a few minutes each day. This approach is especially useful for those who do not have the time or resources to dedicate fully to investing but want to be successful in the market. The 2-minute routine concept. Lynch begins the chapter by explaining that the 2-minute routine does not mean investors should act hastily or without thought. Instead of conducting a superficial analysis, it involves a quick and efficient review of key aspects of a company to quickly determine if it's worth further investigation or if it should be discarded. This approach is designed to optimize the investor's time and energy without getting lost in unnecessary details. The key to this routine is simplicity and practicality. There is no need for complicated technical analysis or to follow every market fluctuation minute by minute. Lynch argues that by following some fundamental criteria, investors can quickly identify companies worth considering and those that probably aren't. How to perform the 2-minute routine. The 2-minute routine begins with identifying companies that may be of interest, based on key criteria that Lynch has developed throughout his career. To do this, investors should look for companies that have a simple business model. Companies with clear and easy-to-understand business models are easier to evaluate and track. If the business is complicated or you can't understand how it makes money, it's probably not the best choice for investment. Generate consistent profits. The investor should quickly review the company's profits to ensure it is generating earnings consistently. Companies with stable and growing revenues are generally a sign of good management and a solid position for long-term success. Have a competent management team. Evaluating the company's management team is a crucial step in the 2-minute routine. The best leaders are those who have a clear vision for the company and can execute it effectively, even during tough times. Operate in a growing industry. A good investment is generally found in companies that operate in sectors with high growth potential. This doesn't mean always investing in the newest or most innovative, but rather in sectors with solid and expanding prospects. Are reasonably valued. It's important that companies are reasonably priced in relation to their fundamentals. If a stock is overvalued, it's an indication that the risk is higher. A quick valuation analysis can help filter out stocks that might not be a good investment. The role of annual and quarterly reports. An important part of the 2-minute routine involves reading the company's annual or quarterly reports. These reports provide an overview of the company's financial health and allow the investor to quickly assess its results. Lynch mentions that it's not necessary to read every word of the report but to focus on the key sections that provide information about revenues, profits, debt, and future projections. Lynch also suggests paying attention to management's comments. A good management team will generally provide a clear view of the company's strategy and how they plan to tackle future challenges. If the management is focused on sustainable growth and has a realistic approach to the future, this is a positive sign. Evaluating the competition. Another key part of the routine is evaluating the competition of the company in question. Lynch explains that when reviewing a company, it is helpful to compare its performance with other companies in the same industry. If a company has a clear competitive advantage over its rivals, this may indicate that it is well-positioned for success. However, if the competition is outperforming the company in key areas, it might be better to discard that investment. The value of simplicity. Lynch emphasizes that there is no need to complicate investment decisions. Often, investors get lost in technical details or feel overwhelmed by complex financial information. However, what really matters is having a clear overview of the company, its results, and its prospects. If the company's fundamentals are strong and there is clear growth potential, that is enough to make a decision. The 2-minute routine is not about making predictions or trying to pick the best stocks in the market, but about conducting a basic and effective analysis of the key factors that determine the success of an investment. The simpler and more direct the approach, the easier it will be to identify the best opportunities and make quick, effective decisions. The importance of discipline. Lynch also notes that while this 2-minute routine is helpful for the preliminary evaluation of an investment, it is important to be disciplined and not let market emotion drive decisions. The key is to focus on the fundamentals and have the discipline to follow this process regularly. As the investor becomes accustomed to this routine, they will become more efficient in identifying the best opportunities without wasting time or energy on those that lack growth potential. Conclusion. Be efficient and effective. Lynch concludes the chapter by emphasizing that success in investing is not about spending hours analyzing each stock, but about being efficient and effective in the process. The 2-minute routine helps investors quickly filter opportunities so they can focus on those with real potential and avoid those that could lead to losses. This chapter reinforces the idea that, with a disciplined and simple approach, investors can make smart decisions without the need for exhaustive or complicated analysis. The key lies in consistency and applying clear, fundamental criteria to evaluate the companies in which one wants to invest. Chapter 19. Some famous numbers. In this chapter, Peter Lynch talks about some of the key numbers that investors should keep in mind when analyzing a company. Lynch explains that while investors tend to overload their analysis with too many numbers and statistics, there are certain ratios and figures that really matter and can provide a clear view of a company's financial health. These numbers should not be considered in isolation but as a tool within a broader analysis to assess a company's investment potential. Numbers are not everything. Lynch begins the chapter by emphasizing that numbers alone do not define a company's success. While it is important to use key financial data to evaluate a company, it is crucial that these numbers are understood in the proper context. Investors should not become enamored with numbers without first assessing the company's business model, management, and sector. Lynch stresses that the key is to use numbers as a tool to better understand the company, but not as the sole basis for investment decisions. The price-to-earnings ratio, P. One of the most well-known and commonly used numbers in company analysis is the price-to-earnings, P/E ratio. This indicator shows how much investors are willing to pay for each dollar of a company's earnings. Lynch explains that this ratio is useful for evaluating whether a company is overvalued or undervalued relative to its earnings. However, Lynch notes that the P/E ratio should not be considered in isolation. A high P/E may be justifiable if the company is in a high-growth sector and has strong expansion potential, but a high P/E in a company with weak growth or low margins could be a sign that the stock is overvalued. It is important to compare a company's P/E with that of its competitors and with the historical average of its industry for a more accurate perspective. The price/earnings-to-growth ratio, PG. Lynch recommends using the PEG ratio, which adjusts the P/E of a company relative to its projected growth rate. This ratio offers a more comprehensive way to evaluate whether a stock is overvalued or undervalued, as it takes the company's growth potential into account. A PEG of 1.0 is generally considered balanced, suggesting that the stock price is aligned with the expected growth. A PEG less than 1.0 may indicate that the stock is undervalued, while a PEG greater than 1.0 may suggest that the stock is overvalued relative to its projected growth. Lynch emphasizes that the PEG ratio is a useful tool to avoid overpaying for a company's future growth. The debt-to-equity ratio. Another important number Lynch highlights is the debt-to-equity ratio. This indicator measures the amount of debt a company has relative to its equity. A high debt-to-equity ratio can be a sign that the company is overly leveraged, which increases the risk during times of economic uncertainty or revenue downturns. Lynch recommends that investors focus on companies with manageable debt. While some companies can effectively handle high levels of debt, especially if they are in sectors with stable cash flows, companies with excessive debt are at risk of facing financial difficulties if they are unable to meet their obligations. Return on invested capital, ROIC. Lynch also mentions the return on invested capital, ROIC, which measures a company's profitability based on the capital it has invested. This ratio is crucial because it shows how effectively a company is using investors' money to generate profits. A high ROIC indicates that the company is creating value with its investments, which is a positive sign for investors. Lynch underscores that ROIC is one of the best indicators for assessing a company's quality. If a company has consistently high ROIC, it means that it is effectively using capital to generate profits. This is especially important because it shows how the company is managing its invested capital, not just its short-term earnings or profits. Earnings before interest and taxes, EBIT. Another key number Lynch recommends monitoring is earnings before interest and taxes, EBIT. This indicator provides a clearer view of a company's operating profitability since it excludes the impact of interest and taxes, which can vary between companies and sectors. EBIT allows for evaluating a company's ability to generate profits from its core operations, without the influence of external factors. Lynch explains that EBIT is useful for comparing companies within the same industry, as it allows one to see which is more efficient at generating profits from its core activities. However, EBIT should also be analyzed alongside other indicators, such as cash flow and net profitability, to get a complete picture of a company's financial health. Cash flow. Lynch emphasizes the importance of cash flow, which shows how much real liquidity a company has available to finance its operations, pay debts, and reinvest in the business. Unlike accounting profits, cash flow reflects the company's ability to generate real money, which is essential for assessing its solvency and long-term growth potential. Lynch suggests that investors pay special attention to free cash flow, which is the money available after the company has covered its investments in fixed assets. Companies with positive and sustainable free cash flow have a competitive advantage, as they have the resources to finance their own expansion projects and reward shareholders. Conclusion: don't rely solely on the numbers. Lynch concludes the chapter by highlighting that, although numbers are important, they should not be the sole basis for making investment decisions. Investors must view these numbers within the broader context of the company, its industry, and its growth prospects. Numbers provide a snapshot of a company's financial health, but the real key is understanding the business fundamentals, its model, competitive advantage, and the quality of its management. This chapter reinforces the idea that while ratios and numbers are valuable tools, they should be used complementarily with a broader analysis of the company. Investors should use these numbers to objectively assess investment opportunities and make informed decisions based on the fundamentals, not on market speculation. Chapter 20: Designing a Portfolio. In this final chapter, Peter Lynch focuses on the importance of having a solid strategy for designing an effective investment portfolio. Throughout his career, Lynch has learned that it's not only important to find good investment opportunities, but also to know how to organize and balance the portfolio to maximize long-term returns while properly managing risk. Lynch offers key recommendations on how to build a diversified portfolio and adjust it over time to ensure steady growth. The importance of diversification. Lynch begins the chapter by explaining that one of the key principles of a successful portfolio is diversification. While many investors may be tempted to put all their money into a few stocks they believe have great potential, Lynch points out that a concentrated portfolio can be extremely risky. The goal is to spread investments across different sectors and asset types to reduce overall risk. Diversification does not necessarily mean having a large number of stocks from different companies. Lynch suggests that a portfolio of 20 to 30 well-chosen stocks can be sufficient to ensure good diversification. However, what's important is that these stocks come from different sectors and have different risk and growth profiles. The key is to reduce overall risk while capitalizing on growth opportunities across various sectors. Invest in what you know. One of Lynch's key recommendations is that investors should invest in what they know. Over his years of experience, Lynch has discovered that the best investors are those who understand the companies they invest in. You don't need to be an expert in all sectors, but it's essential to understand the product or service of the company and how it generates revenue. Lynch encourages investors to focus on companies and sectors they already understand, either through personal experience or direct observation. If an investor already has experience with a certain type of product or service, they can more easily assess its potential and associated risks. This doesn't mean an investor should limit themselves only to what they know, but they should ensure they have a deep understanding of every investment they make. Balance between growth and value. Another important principle Lynch discusses is balancing growth and value stocks within the portfolio. Growth stocks are those with high expansion potential, but they also tend to be more volatile. On the other hand, value stocks are usually more stable and generate consistent profits, although their growth potential may be more limited. Lynch suggests that a well-balanced portfolio should include both growth and value stocks. The balance between these two types of stocks depends on the investor's goals, risk tolerance, and time horizon. For younger investors or those with a higher risk appetite, growth stocks may be more attractive. For investors seeking stability and protection against market volatility, value stocks may be a better choice. Long-term approach. Lynch stresses that the key to long-term success is maintaining patience and having a long-term perspective when building a portfolio. Investors should be prepared to hold their investments for a long period and avoid the temptation to sell when the market experiences volatility. Patience is essential for allowing investments to grow over time and benefit from companies' competitive advantages. Lynch also emphasizes that one should not react impulsively to market fluctuations. The stock market will experience ups and downs over time, and successful investors are those who are not swayed by fear or greed. Maintaining a long-term focus allows investors to take advantage of growth trends and weather short-term volatility cycles. Portfolio review and adjustment. Although patience is key, Lynch also notes that investors must regularly review their portfolios to ensure they remain aligned with their goals. Market conditions change and companies evolve, so it's important to adjust the portfolio as needed. Lynch suggests that investors review their portfolio at least once a year to ensure there are no companies that are no longer a good investment or that are falling behind compared to the market. Lynch recommends being attentive to fundamental changes in the companies they invest in. If a company stops being competitive, has poor management, or loses its market advantage, it may be necessary to sell the stock. On the other hand, if a company continues to show solid growth and has good strategic positioning, it may be a good idea to keep it. The importance of position size. Lynch also discusses the importance of maintaining the right position size within the portfolio. One should not risk too much on a single investment, even if one believes strongly in its potential. Lynch suggests not having more than 10% of the portfolio in a single stock. This ensures that if one of the investments doesn't perform as expected, it won't have a devastating impact on the overall portfolio performance. At the same time, Lynch suggests that investors should not limit themselves to holding many small stocks in their portfolio. It's important to have some larger, well-established investments that provide long-term stability. The key is to find the right balance between risk and return. The importance of dividends. Lynch also mentions the importance of dividends as an additional source of return for investors. Companies that pay dividends not only provide consistent income but also indicate that the company is generating enough cash to share with shareholders. Dividends can be particularly valuable during periods of market volatility, as they offer a steady income stream even when stocks are not rising. However, Lynch warns that not all companies that pay dividends are automatically a good investment. Investors must ensure that dividends are sustainable and not being financed by debt or non-recurring earnings. Conclusion: designing a balanced portfolio. Lynch concludes the chapter by emphasizing that designing a successful portfolio is not about finding the perfect stock or trying to predict the future of the market, but rather maintaining a balanced and disciplined approach. A well-designed portfolio should include diversified stocks from different sectors, balance growth and value, and maintain a long-term focus. Investors should also be flexible and make regular adjustments as market conditions or company outlooks change. This chapter reinforces the importance of having a solid and balanced strategy rather than following market trends or acting impulsively. Investors who design diversified portfolios and maintain discipline are more likely to achieve long-term success. Conclusion: the power of being an individual investor. Peter Lynch concludes his book by underlining that individual investors have a unique advantage over institutional investors or large investment funds: the freedom to act without market pressures. Institutional investors must meet the interests of their clients, which forces them to focus on short-term results. Individual investors, on the other hand, can take their time to find good investment opportunities and hold their stocks long-term without the pressure of having to justify decisions in a short period of time. The value of personal research. Lynch also emphasizes the importance of doing your own research before investing in any company. He firmly believes that the best investors are those who invest in companies they understand and thoroughly research before making a decision. It's not just about following recommendations from analysts or market experts, but about learning and understanding each company and its potential. Moreover, Lynch reinforces that it is not necessary to be a financial expert or have unlimited resources to be a successful investor. Individual investors can find great investment opportunities in companies that are under the radar of large funds, and with diligent research and a long-term mindset, they can achieve outstanding returns. Invest in what you know and understand. Another crucial point that Lynch highlights is the importance of investing in what you know and understand. Investors should look for sectors or companies they are familiar with or have personal knowledge of. This allows them to assess opportunities more effectively and make informed decisions. By investing in companies whose business model they understand well, investors can quickly recognize whether an investment makes sense or not. Patience is key. Lynch stresses that patience is one of the most important components of being a successful investor. Investing should not be seen as a way to make quick money, but rather as a long-term process. Often, great returns come from holding investments for years, without being swayed by the short-term volatility of the market. This approach allows investors to enjoy consistent growth while the market goes through its ups and downs. The future of individual investors. Lynch closes the book by highlighting that, although markets will always be filled with uncertainty and fluctuations, investors who follow these basic principles will have a great advantage. The future is uncertain, but with patience, research, discipline, and a focus on the fundamentals of companies, investors can be better prepared to take advantage of opportunities and protect themselves from risks. In summary, One Up on Wall Street is an accessible yet deep manual for anyone interested in learning how to invest intelligently. Lynch offers a clear and pragmatic perspective, explaining how to make informed decisions and find great opportunities in the market while managing risk effectively. If you enjoyed this content and want to continue learning more about the world of investments, don't forget to subscribe to stay updated on new analyses and strategies to improve your financial decisions. See you in the next chapter.